Welcome everyone to our third quarter investment webinar. Inflation remains the main headline impacting stocks, and news on that front indicates the Fed's hikes are working as planned. In combination with continued job strength, we have about as positive an economic news front as could be expected. Adam will address this in more detail. To date, stocks have completed a near full recovery from last year's sell-off. Andy will cover how we're positioning to maximize return potential ahead. We and Schwab have shared numerous communications regarding the upcoming September 5th transition. We expect this transition to proceed smoothly. This is based on our decades-long experience with Schwab as either our number one or number two custodian. Our team will, of course, support you through this process. Adam?
Thanks, Lowell. And just kicking it off with the general review of market index returns for the quarter. Despite what you might have seen in the headlines, especially in early April and into May, domestic equities closed up positive again for a second straight quarter, as did international developed and emerging markets, and also real estate, traded real estate with a nice recovery quarter. Bonds are still relatively flat for the year, despite the continued rise in interest rates. We've seen those rates hikes slow down a little bit, but bonds are from a total return standpoint still muddling their way through, although bonds in and of themselves are finally paying a attractive rate of interest for the first time in quite a while. And the key theme for the quarter, and even end of last quarter into this quarter, is if you kind of saw on paper all the things that happened or were going to happen and tried to translate that to some sort of a market return, you probably would have come up with a much more pessimistic estimate compared to what actually happened. So the big theme is the resiliency of both the markets and the economy. It's been specifically interesting to watch the headlines change over the last 6 months from, talk of potential really deep, severe recession, a continued second leg of the bear market, and now just, the last couple of days, I've been noticing headlines popping up asking the question, are we in a bubble? So it's been very interesting to watch investor sentiment turn from really, really negative to fairly positive, all while the economy's held up a lot better than expected. And Andy's going to get under the hood of the market, specifically the U.S. stock market, talk about what's happening in the various segments as it relates to size and style. But in general, really patient investors have been rewarded so far this year. And a lot of the major negative concerns have fought themselves off one at a time. And if we take a little bit more of a step back, the last 1 year, 5 year and 10 years, you'll notice, similar to what we've seen for a while now, just as you look further back in time, you notice the resiliency of the market and, equities in general being a great source and a place to give yourself the best odds to beat inflation and preserve your purchasing power over time. Some of the big discrepancies that still remain from a global equity valuation standpoint, the U.S. market continues to be the main driver of global investment returns. The international markets, both developed and emerging, had a really nice bounce back year last year through some of the turmoil and the bigger sell-offs, but still on a 10-year trailing basis are lagging behind. So just in terms of overall diversification, these trade-offs between domestic and international returns are cyclical in nature. So having some exposure overseas as part of your overall investment mix still makes sense on a forward-looking basis. And the bond market, really being a big story of after decades of declining interest rates. We've seen bonds, fight themselves through a 0 to 5% Fed rate hike, and those investors in bonds have had to kind of shift their thinking from price return to income return, as those bonds are now yielding a higher rate, but still trying to recover from some of the price return sell-offs of the last 18 months. So in general, a fairly let's call it exciting quarter, not a boring quarter, given we're close to double-digit returns domestically. But another really great example of markets aren't always going to behave like the way we expect them to behave. Patience will reward even those investors second guessing their allocations, and the stock market and the economy aren't always hand in hand. So just like 2020, 2018, 2008, things tend to bounce back and recover before they feel safe or we get the all clear signal. And so we appreciate our clients hanging in there, being disciplined, and navigating through some of the volatility of the last 18 months. From an economic standpoint, when you go through these periods of really aggressive rate hikes, like I said before, we went from essentially a zero interest environment to aggressively working our way up to a 5% short-term rate. And although we're not completely sure if and when the Fed is actually done, they've definitely took their foot off the gas a little bit, which was welcome news, and a big part of the big reason for the wind behind the sails of the equity market. Whenever that happens, the big question is, what is this going to do in terms of damage to the economy? Although inflation got the headline in terms of the reasoning behind the rate hike, typically it's not as simple as raising rates just to get inflation down. There's usually some sort of damage that happens along the way, depending on the dynamics in the economy. And that's when you think back even 6 months ago in the end of 2022, the big growing concern was these rate hikes are getting more aggressive. What does that mean for the economy, specifically the labor market, the consumer? At what point are these higher rates going to really restrict the flow of money into the market and the economy, and really do the type of damage that might translate to a really deep recession? And a big reason behind the optimism in the markets has been we just haven't seen that negative spillover effect yet. Does that mean that at some point, as this continues and there's further hikes, we don't see a shallow or mild recession? It doesn't mean that that's not going to happen. But the major concern of a catastrophic economic impact has been eliminated, or at the very least that can has been kicked down the road because of how resilient two pockets of the market have really been. The first being the labor market. One of the key drivers of any recessionary environment is job losses, and deep job losses, and a quick turn in job losses. And we've seen, still a comfortably sub 4% unemployment rate, and we're adding still several 100,000 jobs a month. I think it's just over 300,000 jobs a month on average, through June. So we've not only have we made back all the job losses from the COVID recession, but we've filled the gap with several million more on top of that. So the labor market it was never going to keep its super hot streak intact, but it's still incredibly resilient and strong, and that means more employment and a healthier consumer. And that's the second piece, the consumer being a big part of why we've really been able to hold strong through a lot of this and these rate hikes. If you go to any airport, you've been traveling this summer, you've noticed what I have is that people are out and about, busy, living their lives, and there doesn't seem to be any kind of slowdown in travel and leisure specifically. The airlines are saying that, the hotels are saying that, bookings are up, and people are still spending down excess accumulated savings from the 1.5 or 2 year break they had from being able to go out and have some fun. And they're also still fully employed. And on top of that, they've got continued pent-up demand and things that they're trying to do and get out and do and live their lives. And so that's been the consumer and the labor market has been incredible bright spots. And the question continues to be, and this is just naturally going to be a key theme of the second half of the year, is how long does that last? Do we see any cracks? And at what point does that potentially turn? And how does that turn in tandem with potential future rate hikes? So the other final piece of this that will glue everything together is going to be answering that question of how many more rate hikes are we going to see? You know, we took a pause last month. The expectation is potentially at most, one or two more hikes. And those odds will change by the day and by the week based on the headlines. But in general, the thought is that, a lot of the big hikes are behind us. And can we kind of piece all this together and put ourselves in a position to avoid any type of major economic damage and move forward? So unfortunately, those questions have yet to be answered, but with the markets just a couple percent off their all-time highs, it seems at least the recent trend is a lot more in favor of the positive headlines and a calm and resilient market and economy. So that's something we'll have to look at specifically over the next quarter, 2 quarters, and report back and see. But as of now, patient investors have been rewarded and the economy's hung in there. So with that, I'm really excited for Andy to dive in specifically under the hood of the U.S. market and some of what we've been looking at and doing inside of portfolios.
Yeah, thanks, Adam. It really feels like it's been a year since we did this past the last webinar in April, because like so much happened this quarter. If you think back to April, we just gotten through March. There was a couple of key sources of uncertainty between the Silicon Valley Bank failure and the aftermath of that with the other mid-sized regional banks, big source of uncertainty in the market. And, also we had the looming debt ceiling hanging over our heads as well. So these things were front of mind. And so, where I wanted to start my section here today was where we left off the last webinar. And we asked the question, was the Silicon Valley Bank, the banking crisis that ensued from that, was that just a flash in the pan? Or was it the turning point in a broader style cycle? So if we remember back, 2022, very strong year for value companies. Value did very well all year long. It continued into January, but starting in February and in March, when we started getting some whispers of the banking crisis, growth stock started doing well. So we wanted to ask this question here because it was really the key thing we were watching, even amid all that uncertainty. This to us is the key question, because if you recall, what we try to do is we want to shift to the size and style cycle of the market that we expect to outperform ahead. So we had been leaning value. We saw some short-term growth momentum. And really the big question was, is this growth momentum just, a short-term deal with, financials in particular taking it on the chin during this time frame? If financials as a sector tends to be dominated by value companies, so are we seeing growth momentum just because bank stocks are selling off, or is this some big triggering event? And the thing that we think about when we think about the cycling dynamic between value and growth is that oftentimes these cycles last a long time. The typical phase lasts about 22 months. So if you look back at this cycle, we'd really been looking at about 2 years, a little bit more than 2 years of pro-value momentum, which is pretty long in the tooth, but at the same time, when we look to switch, so when the market looks to switch from one phase to the other, there typically does need to be some sort of a triggering event to make it happen. So just because a phase is long in the tooth doesn't necessarily mean it's going to stop. That momentum can be self-fulfilling. But on the flip side, with Silicon Valley Bank, we were asking ourselves, is that the thing that's going to flip the market? And, so what we were really asking for with the last webinar was just a little bit more time so we could bring in a little bit more data to evaluate whether the shift to growth was just going to be a brief counter trend that happens all the time against a broader pro-value phase, or if it had staying power. And, what we've learned really through the past, couple months of data is this looks like it was the turning point to a pro-growth market phase. And so, one of the ways we like to show this is with this chart here. We've shared this chart a number of times in these webinars, and basically if you see blue, that means over the past year, value has outperformed growth. And if you see gold, over the past year, growth has outperformed value. And so that's important context. But the other thing that's important is the direction of the line on this chart. And so, the last time we spoke, it looked like maybe the direction was beginning to turn negative. Fast forward 3 months, you can see with the arrow that I have here on this chart is it's pretty aggressively, turned towards growth. So over the past year, if you squint really, really hard, you can see at the end of June, there actually is a little bit of gold there, which means that over the last 12 months, growth stocks have actually outperformed value stocks very slightly. And so what typically happens is this is a very cyclical, trend in the market. And you can see here, it's quite well patterned. And what normally happens is as soon as that line crosses the 0% origin here on the chart, you get a sustained phase in the other direction. So it seems, and we've got some, modeling that we do on the back end that backs this up as well. But it certainly seems like this pro value phase, which was a pretty healthy one, both in terms of magnitude and in terms of length, has wrapped up. And our expectation is that over the next, let's say 18 to 26 months, we would expect growth to hold the edge. And that's certainly been the case. So the way that we execute this in portfolios is that we oftentimes shift pretty aggressively one way to the other. So this is what I'm showing here on this chart is what our value targets have been over the past little bit more than a decade, going back to 2010. And you can see that when we say size and style responsive, this is what we mean. So, when we're up above 0.5, so 50% on this chart, that means we're leaning into value. When we're below that, that means we're leaning into growth. So in the past quarter, in the month of May, we made the decision to go to a neutral posture with regards to style, which means that we took that 70% value tilt that we had and we brought it all the way back to 50-50. And then right at the end of June, we made the decision with, 1 more month's data that we should go even further. So given that we're expecting a full-blown growth phase to materialize and last for some time, we've shifted the portfolios even more so into growth. So, that's something that we're actively doing this quarter. And it'll be a big point of emphasis for our trading team. The one thing I did want to point out is we have a mix of taxable accounts and IRA accounts. And so whenever we're trading those taxable accounts specifically, whenever we go to rebalance, it's always a trade-off in our mind. Is it worth it to take this gain? Do we expect these trades to increase our expected return to the portfolio? And how does that weigh up against the gains we might realize? And sometimes we'll have opportunities for tax loss harvesting where we can be a little bit more aggressive. But with this trade, I will say the most important reason we trade is to make sure we get our size and style targets and our posturing right in your portfolios. You've heard us in the past talk about stock selection, and we do think that it's important. But the truth of the matter is your size and style positioning is going to override anything we do from a stock selection standpoint. Like you can have the best stock selection model in the world, but if you're trying to buy, value stocks when growth stocks are expected to be in favor, you're probably going to have a tough time as far as performance goes. So I bring this up to say that we are going to be fairly aggressive, and we have been fairly aggressive moving portfolios from value to growth because we do give extra weight to that type of rebalance. We just think it's more important, and it overrides and to some extent tax considerations to make sure we get those portfolios to our new factor targets. And so I wanted to say that one, just, as a warning, if you do have taxable accounts with us, it might make sense to take a look at your year-to-date realized gain and just see where you are. it might be a good opportunity to do some mid-year tax planning. And I want to bring that up in the month of July, not the month of January or December, because I want you to have plenty of time to make adjustments to that. So I think that's one key consideration. I will say that we do, our strategy is pretty flexible and pretty customizable. And for many of you, you do have customized allocations. And one of the customizations that we often see are realized gain tax budgets. And, we do honor those even when we make these shifts. So if you're in that boat, it might make sense just to confirm. But I will say that, when we are making a big shift, for example, from value here to growth, and, there's too strict of a gains budget, sometimes that can really hamper our ability to deliver return. So there's a bit of a trade-off there sometimes. That being said, we are going to continue to look for tax loss harvesting opportunities as we get later on into the year, and as those types of options materialize. I just wanted to give everyone a quick heads up that we are fairly aggressive when we make the style shift, and that's our intention. I think some people, Adam, you shared the chart showing the stock market performance. And I think one of the really, interesting things of the stock market is, especially in recovery phases, oftentimes the stock market doesn't make sense. Like sometimes it's hard to tell a story, about it, but oftentimes the market's right at the same time. We saw this in COVID when the market bottomed in March of 2023, and all we got was negative COVID news about hospitalizations, but the stock market went up aggressively. And I feel it's kind of the same now with growth, because the Fed still is raising interest rates. And the fact of the matter is, in a rising interest rate environment, that's usually a tough time for growth companies to perform well. And in fact, a major reason why growth underperformed so much last year was because the Fed was so aggressive in raising rates. But the Fed isn't done raising rates. Now we're seeing growth have some momentum. And I think it's a good time to remember that the stock market is a forward-looking machine. It doesn't necessarily care about what's happening right now, or even what the Fed's going to do in July or August. What I think is really being priced in here, and the reason we're seeing growth stocks begin to make this run, is because the expectation is the Fed won't have to keep being so aggressive with its rates. So there was already a re-rating of many growth names. Now it seems like the Fed is at least going to, they hit the pause button, they raise rates again. It seems like the market is pricing in the case that, the Fed might actually begin to start reducing rates, maybe in 2024, maybe in 2025, there's a higher likelihood of that happening. And in that type of environment, that would be a good thing for growth companies, because it allows growth companies, one, to borrow and reinvest in R&D at greater rates. And it also just makes the math work better behind valuation. So, that if you're looking for like a reason why growth is having this move, I think that's a good one. So the question that we had, Silicon Valley Bank, is it going to be an enduring shift from value to growth? Our answer is yes. But there are actually some other implications of that time in the market as well. And, specifically, I think around which stocks were doing well this year. So I wanted to take a moment to talk about that, because, while we do think the shift to growth is going to last a while, this, I'll call it a risk off move in the stock market, had some pretty big implications that I think the top line S&P 500 performance number year to date sort of obscures a little bit. So, if you look at just the biggest mega cap tech stocks, by market cap, so by size of these companies, we know that they make up a disproportionate, portion of the market cap. And so here you can see it's, about just over 20%. These 6 stocks right here on this chart make up more than 20% of the S&P 500, even though, it's just 6 out of 500 companies. So that's a really big weight. So these are very important companies. And the other thing that's sort of odd about them is they're almost like, they were so big, they have so many different business lines. They're almost like a safe move. So when things get uncertain, sometimes you see these stocks hold up relatively well at the expense of everything else. And that certainly was the case. So if the middle bar here shows the return contribution of just these 6 mega cap tech stocks from January through the end of May, when things were maybe at their most uncertain. And you can see that they contributed for nearly all of the S&P 500 returns. In fact, if I throw Google into this mix as well, it actually contributed to more than all of the returns, which implies that the remaining, 493 stocks actually saw negative returns, even though the S&P 500 number was positive through the end of May. And there's just been this really large divergence if you look at the market cap weighted version of the S&P 500 versus the equal cap weighted one. And so I think where this comes into play, for us with our stock selection modeling is in the aftermath of these big bear markets, we do lean into companies. We have a supplemental model that we turn on that leads us into the companies that should do well in a market recovery. But it is a double-edged sword to some extent. So when we get volatility, it can sometimes work against us. And we did see that specifically from March to May, but really in the month of March was the big one, where that was a little bit of a headwind for us. And so, I think when we see such a narrow market, really that's going to be a tough, market if you're investing in anything but the very largest companies, and it was. But I think the good thing is once we got past May, we had First Republic Bank was finally acquired by JP Morgan at the beginning of May, and that sort of put an end to the regional banking crisis. We obviously had the debt ceiling deal between Republicans and Democrats right at the end of May. And so from June on, really the only piece of uncertainty was inflation, and the news was good. And so what we've seen is a much healthier stock market where there's been much more breadth. And so you can see from that last bar on this chart is just the month of June. And the gains to the market were much more broad-based. Sure, the mega cap tech stocks also did well, but the rest of the market began to catch up. And this only goes through June, but if we fast forward through July so far this year, it's been the same thing where we've seen the rest of the market doing really well in addition to the top names. So I think the upshot for us is, if it's just like the top 6 or 7 stocks that are doing well, investing really isn't that hard. Just invest in those stocks, and we do that. But I think where we can really add value and is with the remaining stocks under the hood. So even below the S&P 500, there's 3,000 stocks, give or take, that are really in the investable US stock market. And, we think there's a lot of opportunity within that bucket specifically, so we're very glad to see more breadth in the market. We think that your portfolio is well positioned to take advantage of those stocks doing well. So one thing I did want to leave us with as well, we did get some questions here in the lead up. I don't know if we've got any questions now. Lowell's been monitoring the Q&A, but we hope we addressed at least some of those questions. We weren't going to do a direct Q&A. I will say that, there were good questions that came in, and I think they're really great questions to have with your advisor. So we're forwarding those questions on. And so that your advisor should be reaching out, or you can obviously reach out to your advisor to make sure that your questions get answered. But before I sign us off, Lowell, did anything come through the Q&A?
Yeah, and I'll say that having reviewed the questions that were presented prior to the webinar, I think what you just delivered was an answer to pretty much all of the questions, as they centered around performance and not just this year, performance ahead, and you kind of covered both of those. So yeah, so we have what is termed question to answer. I'm not sure which of us is most appropriate, but how do you view the switch to Schwab as affecting your strategies, in view of the fact that Schwab has many of its own products to offer and might influence your decisions? I can take that, or unless one of you guys want to.
Yeah, go for it.
So, as previously mentioned, we've been utilizing Schwab and been aware of what their offerings are for decades, actually. So, we're very comfortable with understanding their mix. I think we had a lot of the same sort of resources available to us at TD as well. And it's a kind of a, how will I answer this? They've got a lot of good standard not alternative, but investments other than stocks. And of course, we have our own approach with how we run the stock portion of our accounts. But What we're often looking for to complement what we do with stocks would be what I'll call more sophisticated than what Schwab has as typical offerings. And you'll see us go to other firms like a Carlisle and, very specific managed futures. And we've got like a mix of other assets. So I don't think there's anything that Schwab has on its platform that will have a material impact on how we execute. So that's my answer. Fellas, you good with that?
Yeah, and I think in general, Schwab, even Fidelity, other investment providers out there, a lot of their business comes from partnering with firms like ours. So Schwab has been in the business of helping custody RIA assets for a very long time. So this is, the acquisition in and of itself is something new for our clients. But as Lowell said, we've had a custody relationship with Schwab for a couple of decades, and they themselves, they really look at it as almost like two different segments of their business. Where, the RIAs offer boutique services to their clients in a very, close relationship with their clients. It's not really a retail environment. It's more of a, a trusted relationship that's more customizable and built on, a whole suite of different services. So they would even argue with you that, what they offer on their end is really retail based and for the masses. And, so it's really, they define it, and we agree, as almost two different services. And they've supported us and our clients for a long time. And we see it more as a partnership than a conflict.
Yeah. And to take a slightly different angle on this too, guys, we view ourselves really as being custodian agnostic. We've worked with TD Ameritrade, we've worked with Schwab, our systems to make sure, from an investment standpoint, that we're executing our trades. They can really work. They're designed to work with any custodian. So as far as like any sort of disruption of moving from TD to Schwab, we really don't expect there to be any. We're well practiced with it. And really, from our perspective, it's business as usual. All right. So Lowell, were there anything else that we wanted to cover there? Any other questions?
No, that we've got a thank you from the one who posed the question. So we just got one more question. Hold on a second. What benefits from Schwab other than entity? So I guess the question is, what do we expect to be benefits at Schwab versus TD? I think my answer would be very little. I think they were the two best discount custodians. And then the acquisition makes it basically there's just one best discount custodian. So I think that what you have experienced at TD and what you value at TD, I think you should expect to basically have Schwab match that.
Yeah, that's one of the big question marks for us at all times. We act as a fiduciary to our clients. And so when there's any kind of a partnership or an outside provider involved, we have to think about, not really what's in it for us, but how do our clients benefit from this? And, we've got, due diligence that we need to do continuously around various potential custody partners. And up to this point in that space, it's really been, their first goal is to, the safekeeping of client assets. So, making sure that, clients, money that's, where it's deposited and where it's kept safe, and feeling really good about that. With Schwab, we absolutely do. And then the other element are there any other services or anything that's out there, as an added benefit? And we haven't really seen as much in that space from them or even others, but it's really the safekeeping of assets, the service, the support, and the technology that we get in helping monitor those assets.
Yeah, and I really think the big benefit that you get from Schwab happened years ago when they forced the entire industry to go commission free with trading. That maneuver even allowed for them to acquire TD Ameritrade in the first place. But I think it's a big benefit to you as the investor that you can do trading in your portfolio with equities and ETFs and not have to worry about commissions anymore.
Yeah, other than that, it'll just be the logo on your statement will be the main, right? Like our service experience with them, will look and feel one way, but the big difference, and any difference, is just the logo you see when you look at your accounts.
Yeah, your accounts are going from green to blue. I think that's the biggest difference.
Yep.
That wraps up the questions, fellas.
Okay.
All right. Well, thank you. Thanks, Adam. Thanks, Lowell, for doing the webinar here today. And again, thank you everyone who attended for joining. We will be recording this, and we have recorded it, and we will be sending it out in the next couple of days. So feel free to forward it on to anyone who you think might be interested. Thanks again.